Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to today's InvesTips podcast. Today we're going to explore alternatives and how they can help diversify and strengthen portfolios. Now, there are strategic reasons to have an allocation to alternatives within a diversified allocation, but in a world with elevated US inflation, this is even more important. We'll also look at the various alternative assets and their outlook in 2026, helping you to position your portfolio for what's ahead. Joining me today is Mischa Bitton, Head of Alternative Investments at Standard Chartered. Mischa, so great to have you here. Thanks for joining me.
Thank you for having me here, Steve. I'm glad we are talking about alternative investment today, at a time where traditional assets are trading at elevated valuations. Investors can't necessarily rely on the old playbook anymore. They need to look beyond the obvious and consider alternative strategies such as private assets, hedge funds, commodities, and digital assets to diversify, hedge against inflation, or unlock higher returns.
Okay, so you mentioned elevated valuations of equity markets, and I guess that's is giving people a real push into alternatives. Could you maybe start by walking us through how adding alternatives changes a portfolio's risk-return profile, and what you think are the key drivers behind their rise as core diversification tools?
Diversification. Diversification is often called the only free lunch, but I think it's misleading. It comes with a trade-off. You give up the highest potential returns of an all-equity portfolio in exchange for stability. However, the practical implications of diversification are far-reaching. By reducing volatility and drawdowns, diversification helps investors stay invested during market stress and avoid emotion-driven decisions like panic selling. The case for diversification becomes even stronger when alternative investments enter into the mix. Adding private assets, hedge funds, or commodities can lift expected returns and improve risk-adjusted performance. For example, our foundation portfolio of traditional assets averages a Sharpe ratio of about 0.59 over the last 5 years, while our Foundation Plus portfolio, that includes alternative investments, reaches around 0.65, so an improvement of 0.06 of the ratio. To understand key drivers for this asset class, let's go back to the basics. The classic 60-40 equity bond mix worked because bonds and equities typically moved in opposite directions. When stocks fall, bonds cushion the blow. But correlations aren't constant. Today, they are much higher, making this traditional relationship weaker. Moreover, since the pandemic, bonds haven't delivered the same diversification benefits. In short, elevated correlation and inflation risk make alternative investments essential strategic diversifier. Given today's environment, investors can consider allocating anywhere between 20 to 30% in alternative investments, including gold.
Okay, so I'm assuming that that 20 to 30% allocation depends on an investor's risk profile and is spread across different alternative assets. So apart from gold, what are the other options investors can look to diversify their portfolios?
Yeah, you are correct, Steve. The allocation is spread across risk profiles. A conservative investor can consider having around 20% exposure, whereas someone with higher risk appetite can consider up to 30% exposure. And as you rightly pointed out, they can be spread across a range of assets, including private assets such as private equity, private credit, or private real assets such as real estate and infrastructure, hedge fund strategies, including liquid alternatives, gold, and digital assets.
Okay, so we're going to walk through each of these assets to understand why they deserve a spot in a portfolio and what to consider in today's economic environment. So what's the current scene and your outlook for the different spaces?
So a lot of people are talking about private credit, which has been certainly one of the most successful asset class in terms of asset raising. But private credit is today facing one main issue. Rapid inflows can lead to rushed due diligence and hidden defaults. But banks, not just private lenders, often bear the losses. The real issue is both credit quality and what is really priced in right now. While we have become more cautious on public credit markets in the recent months, we believe that private credit is likely to be more resilient, with credit defaults well under control. Key ratios such as interest rate coverage, debt with EBITDA ratios are actually improving thanks to lower base rate and economic growth. So we suggest that investors stay cautiously optimistic and focus on top tier managers with first look on deals. From a geographical standpoint, US dominates headlines, but Europe also looks attractive as demand supply dynamic are relatively more in favor of the lenders. The bottom line is that private credit remains relatively attractive when compared to public credit, but execution through strong managers is critical for sustained success.
Okay, I think that's really good, and I think loan vintage can also be important, right? So when we're looking at some of the deals done before the spike in interest rates, obviously some of those are running into trouble. So also that's an important factor to look at. But I think that comparison between private and public credit is actually really interesting. So we prefer private credit to public credit in this environment. Okay, let's move on and look at private equity. So what's your take here?
So we spoke about private credit, which is actually mostly financing private equity managers. So what does it look like for private equity managers? So I feel private equity offers clear benefits, boosting returns, improving diversification, often with similar or lower volatility when compared to traditional assets. There is a trade-off, longer holding periods, and illiquidity, which most investors, I believe, can handle more than they realize. A big part of doing well in private equity, beyond picking strong managers, is timing. You mentioned 2020, 2022 vintages. Yes, they are likely to be challenging. But on the bright side, I think today the backdrop looks much better. In particular, central banks are easing rates. And we see also tighter credit spreads. So both are valid and supportive conditions for private equity investments. In a nutshell, investors should diversify across styles and themes, focus on managers with strong track record, and consider secular trends such as digital transformation, cloud software, energy transition, and AI enablement.
Okay, I think the final area we want to look at within private assets is private real assets, which obviously real estate and infrastructure. So, can you walk us through those two segments and see how you see them playing out in the future?
Let's start with real estate, both private and public markets. Both went through a really tough time after COVID as the dynamics changed dramatically and we saw much higher inflation, especially in the US market. However, we've seen a situation that looks like stabilizing and improving over the last 12 to 18 months. With both monetary policy easing and tightening credit spreads, transaction activity is likely to increase, and capitalization rates are likely to retreat from 10 years highs. What does that mean? When cap rates are going down, the valuation are going up. The US residential market could benefit from the constrained supply from slower new development volumes in single and family and multifamily housing. With aging population, senior housing is an area of significant opportunities, but it comes with risk, regulatory and reputational risk that require careful management. A slowdown in supply growth and shifting demographics are likely to lead to increased pricing power and the need for better financing. Globally, data centers remain a key growth segment, driven by heavy investments in AI infrastructure, and are likely to be an important source of returns for real estate investors in the coming years. So now let's turn to infrastructures. What is happening? And I think in today's environment, the needs are huge. We speak about $100 trillion of investments in infrastructure by 2040, according to some estimates. Growing populations, AI data centers, renewable energies and grid systems, water systems, roads, rails, are likely to drive the growth of the segment. For investors, private infrastructure could offer stable, inflation-protected cash flows, low correlation to traditional assets, and less volatility when compared to public infrastructure markets.
Okay, so I think that's fairly comprehensive on private assets. So thank you for that. Let's move on to hedge fund strategies. Also, these are powerful diversifiers. We look at this from from four different asset classes or sub asset classes. So maybe let's go through those one by one. Can we begin with global macro strategy?
So, under global macro, managers bet long and short across assets such as stocks indices, bond indices, commodities, currencies. Often, managers will use leverage to boost returns. Historically, performance has hinged on key commodities like gold or oil, equity indices like the S&P 500 or emerging market indices, and the US dollar. Today, we are overweight EM assets. We expect a weaker US dollar over the next 12 months. We see high valuations in DM equities and more broadly, erratic policymaking. It raises the risk, but also investment opportunities.
Okay, so another area is equity long short, where a fund manager looks for pricing anomalies between different stocks. So buying an undervalued stock, selling an overvalued stock, for instance. So could you offer a sort of breakdown of how this works and what your expectations for this strategy is for 2026?
When we look at historical returns for equity long short, we see a strong correlation with the equity market. But it comes with lower volatility as the managers are close to market neutral for most of them. Performance can rely on two factors: beta, the performance of the stock market, and alpha, the ability of the managers to pick winners and losers. In generating alpha, marketing efficiency matters. When we look at the US market, it's a highly efficient market, and it makes alpha consistency very difficult to achieve. While China and India have historically offered rich alpha opportunities. At the same time, low sector correlation in the US still create attractive ground for equity long short managers. The fact that we are overweight on our foundation portfolios works well for equity long short strategies. High valuations, but also valuation dispersion suggest managers should have opportunities to deliver both alpha and beta. Therefore, this is a space where we are positive in 2026.
Okay, let's move on to a closely related area, I guess, event-driven strategies, which focuses on special events such as mergers and acquisitions and distressed companies. Maybe you could, briefly cover relative value strategies as well, which is similar to equity long short, but more in terms of public credit markets instead. So, what are your thoughts on those two areas?
So let me start with event-driven first. The key drivers include positive equity market outlook, reduced financing cost, and a rising cross-asset correlation. Amid these factors, we expect a rise in M&A activities. In the coming months, we expect the pace of policy changes to slow and deregulation to help boost activity. If we have to pick a sector, pharma is one of the sectors that is providing significant opportunities in the space. Overall, we have a constructive views on the outlook for this strategy in 2026. Now let's look at relative value. It tends to do well when credit spreads are narrowing and when equity markets are doing well. Greater credit spread dispersion would also be positive for the strategy as it creates opportunities for managers to deliver alpha. Today, we are wary about public credit because spreads are very tight and there is little buffer if the economy is weakening. With spreads so compressed, there isn't much dispersion to exploit either. So we are keeping a relative value in our alternative sleeve underweight.
Okay, a final area, just maybe a brief comment about the outlook for gold. Obviously, it's an important diversifier. Your thoughts here?
Gold has been a powerful diversifier in portfolios, and we remain positive on the asset class for many reasons. After the Russian sanctions, emerging market central banks have been steadily buying gold. They are likely still below their target reserves, but it doesn't seem to provide a floor consistent with a rising trend for gold price. Real interest rates are likely capped, which is a key input for gold to gold return models. This should be another supportive factor for the gold outlook. In essence, we enter 2026 overweight on gold with about 5 to 7% allocation in our portfolio.
Okay, thanks, Mischa. So, yeah, a rising gold price. I think we've got it looking at around 4,800 target price this year as well as that 5 to 7% allocation. So, thanks for giving such a comprehensive outlook on the benefits of having alternatives in a portfolio. I'm sure our listeners found this discussion very interesting and meaningful, and hopefully giving them lots of different ideas on how they can strengthen their portfolios going forward. To all our listeners out there, thank you so much. Mischa and I would like to thank you for joining us.
Thank you very much.
To learn more about incorporating alternatives and building a future-ready portfolio, please visit the link in the description, and I will talk to you again soon. Until then, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.